Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
Hello and welcome to another one of our series of webinars intended to help savers worry less about money. This particular workshop is entitled Overfunded Life Insurance, the Secret Trump Card for Savers. I don't play a lot of bridge, but in the game of bridge there is a trump card. Other card games have had trump cards, and what happens is if you have the trump card, that literally trumps anybody else. So they put out a hand or a card they thought was better than yours, and you toss out the trump card, they're done. So retirement planning over the years has changed a great deal since my granddad retired. You have to build into your plan various trump cards to deal with the changes that are going to take place as you get older. Now, you'll see this next slide, and I talk about this in my book, The Worry-Free Retirement. Years ago, I came up with this concept of what I call the 3 halves of life. Now, what we were saying here is you go through different phases in life where money is going to be treated differently. In fact, if we take a look at this graphic here, we can see that in the first half, you see the young couple there. Generally, that's between the ages of 25 and 50. Those are the ages that you need to save. Save hard, at least 15% of your gross annual income is what I recommend. Then as we move into halftime, those are the years that you should be enjoying your money, generally between the ages of mid-50s to mid-60s. Again, just depends on your circumstances. And finally, what we call the second half of life, that's when you should be relaxing. That's a period of time where you're probably not going to be doing as much traveling. You should not have a lot of money in the market at that point. You should just be enjoying the fruits of your labor. And hopefully you also have stopgap measures, which we'll talk about, to make sure not only you don't run out of money in retirement, but also if you wish to leave money at your death, we're going to talk about this, we can leave the money on a tax-free basis. We don't want to leave tax tumors to our family when we die, which if you've got 401ks, IRAs, thrift savings accounts, again, all of this taxable money is going to hit home when your family inherits this money at your death. So what we're talking about today, we're going to specifically talk about these 3 halves, but in particular, I want to start off with this first half of life. Many people, we have a lot of clients that are retired, but many clients will come up to us. In fact, one of our staff members, Aaron, just shared this the other day. He was out in public. Somebody asked, do you all work with younger folks? Aaron told him, yeah. We sure do. How old is the person you're talking about? They said 18 years of age. And we said, well, our padded answer is we could do something called overfunded life insurance. And the person's like, what? What is overfunded life insurance? Well, that's what we're going to talk about today. Now, many people ask, well, what is the basis of overfunded life insurance? What is it actually called? What we're doing is we're using the tried and true product known as dividend participating whole life. We don't use term insurance, we don't use adjustable life, we don't use universal life. The reason is those products do not assure the customer of both the cash value and the death benefit. It's kind of like a house when you think about it. Most people want to own a home, they want to buy a home, they don't want to rent all their life. Well, it's the same way with life insurance. Why in the world would you put all this money into a life insurance plan, let's say like term life insurance, when possibly you're not even going to get any of it back? You see, folks, the insurance companies have all the numbers. They're called actuaries. And these actuaries study the science of when people die. So think about it. Maybe you're sitting there right now. Let's look at this illustration. Let's say you say, well, I got a term policy, Tony, and it's only $1,000 a year. I don't want to put all this money into overfunded life insurance. Term is so cheap. Well, is it really? So as you can see from this graph, if you take $1,000 a year and hand that over to a life insurance company for 20 years, that's $20,000, right? And you'd say, well, yeah, that's right. I'll drop it. I don't need it, right? No, you're wrong, because the $20,000 continues to lose interest that you could have made for the rest of your life. So for instance, there's a lot of people on radio and TV saying you should buy term and invest the difference. So what we have to accurately do to see what was the true cost of that life insurance is, we have to take that $1,000 a year, we have to multiply that out at 8% a year, right? If that's the return you think you can make. And you don't just, that's called an opportunity cost, folks. You don't just stop at the 20 years. So at the end of 20 years, you have this cost. But then if we move forward, because right, you could have died anytime after that, or you will die eventually. Let's say death doesn't occur until 30 years after that. Well, you lost the opportunity cost for the 20 years, you dropped the life insurance, so nobody's ever going to see anything. So then you're also going to lose the cost of the premium moving forward. So folks, term life insurance has its place. We're not saying you don't buy term life insurance, but actually, if you don't use the term life insurance, it is the most expensive form of life insurance you'll ever buy. So when people talk about term life insurance, just remember there's a cost. Certainly it has a place, but that's why we want to review your situation. Same thing with universal life or adjustable life. If you bought a policy in the 80s or 90s, you probably are not paying enough into that, and that eventually is going to lapse. It's going to fall apart, and you're going to lose your coverage, thus another opportunity cost. So in addition to that, let's do something too. For the first 10 people that watch this webinar that contact us, you'll have to go to the Contact Tony page on the Worry-Free Retirement, the Tony Walker Financial website. Let us know that you've watched the webinar. Make sure we have your contact information. Say, I'm watching the webinar on overfunded life insurance. I'll be happy to mail you a hardcover book, one of my books, Don't Follow the Herd, because on page 110 of this book, it's really interesting. This is my oldest son's policy, an overfunded policy that he took out. Let's kind of zoom in on this and go over this policy real quick. So 110 of the book, Don't Follow the Herd. Let's get over there. All right. So as you'll notice here, again, this is my oldest son, Philip. He was 23 at the time. He put in $500 a month. Now, a lot of people say, gosh, that's a lot of money. Well, your future's worth a lot of money, isn't it? Now, granted, we could go a little lower than this, but in general, for an overfunded policy to work, you need about $250 a month that you can commit to. It's funny, I was talking with another staff member the other day, Gina, and she said, well, Tony, as people get older, what if they can't afford that? And I say, now, come on, Gina. For $250 a month, how important is it to secure your future and also protect your family? I mean, a lot of people, I don't know about you, my cell phone is over $250 a month by the time you throw in the kids and everybody else. So $250 a month, the beauty of this overfunded life insurance plan is, number one, the premium will never, ever go up for the rest of your life. Let me repeat that. No other insurance promises that. So if you set up an overfunded life insurance policy through us, we can guarantee you that the insurance company backing that contract will never increase the premium. So Philip knows, even at age 65 or 70, $500 a month will not go up. Now let's think about this. In this case, inflation is working for us because inflation obviously gets higher and higher, meaning the dollar is worth less. But if you're 30 years from now, like Philip, I reminded Philip, I said, Philip, in 30 years, you're putting $500 a month in this thing. That's going to feel like nothing. But let's kind of slide down in this illustration and let's go down to age 65, okay? So in this example, Philip, assuming he's put in $500 per month every month, as he's supposed to, and assuming the current dividends, which are very, very low, illustrated right now, pay the dividends, at age 65, look at that, $6,000 a year. It hasn't gone up. Plus, by the way, if Philip were to have gotten totally disabled, they'll pay the premium for him for the rest of their life. 401k won't do that. Okay? By law, you can't even put money in a 401k. So it's a self-completing concept that continues long after your disability, should a disability occurs. But look at this. Based on current dividends, at age 65, Philip would have $883,000 of cash value accessible to him. Now, how can he take it out? He hadn't paid any taxes on any of this money. He hadn't paid any fees. He can take out up to his basis, which would be equal to his contributions tax-free, or, my favorite, take loans against the policy. Why not become your own banker and borrow money from yourself? And we'll show you how to do all these things. It's not that complicated. But here's the real trump card. Remember, we know Philip eventually is going to die. And secondly, we know Philip is going to want to enjoy all of his retirement accounts. But how are you going to do that without running out of money? You can't. We would set up appropriate accounts for his retirement accounts. Eventually, when Philip dies, these accounts may be worthless. These are called annuities. So if Philip lives long enough, he's going to have annuities to pay him a lifetime income. But when he dies, not if, when he dies, in this example at age 65, look at this. The death benefit is projected to be tax-free $1.7 million. And let me repeat that. That is tax-free. Folks, to die and leave $1.7 million to your kids or your grandkids. And you can do this at any age. Obviously, it's more dramatic if you're younger because you've got time working for you. But even if you're at halftime or the second half of life, maybe you're sitting out there right now and you got money languishing in the bank, earning next to nothing. Maybe you've got an old 401k and you're trying to take money out of it and you're trying to figure out where to invest that. There's all kinds of examples where overfunded life insurance can provide tax-free benefits to you if used properly, and of course, when you die, tax-free benefits to your family. So to get a free illustration on this, to see the value of overfunded life insurance, or to meet with me in person, it's not a problem at all. Be sure to log on to TonyWalkerFinancial.com, click on that Meet with Tony button. Be sure to put on there that you're interested in reviewing the concept of overfunded life insurance. And again, for the first 10 people that go to the Contact Tony page and ask for the free book, Don't Follow the Herd, be sure you reference that I watched the Overfunded Life Insurance webinar. That's the only way you're going to get this book. We'll mail you a copy of Don't Follow the Herd absolutely free. As always, feel free to give us a call at 877-499-WALK. That's 877-499-WALK. Well, until next time, I'm Tony Walker with TonyWalkerFinancial.com. You make it a good day.